And Eric, when you talk about the oil ETFs, frequently you talk about USO because that is what? The most popular oil tracking ETF, right?
Sure. USO, the United States Oil Fund, is $2 billion. It's by far the biggest. USO tracks oil futures. All right, so it's different than, say, XLE, which is oil companies. So when you track oil futures, a lot of people use USO just for sheer convenience. But all it does is maintain a position in the front month futures contract of WTI crude. Now, it is down 4% this year, which I think a lot of people would find shocking because oil is actually up about 7%. So this ETF is really for short-term use. And the reason for that is because if you're holding a front-month future, nobody wants to get oil delivered to their house. So as it gets closer to expiration, the ETF has to jump to the next month to maintain the position. And that usually has a cost. It's called roll cost, and that adds up to about 20% a year. So people in this have itchy trigger fingers, and they should. And you've seen about $1 billion come out in May, even though it took in a few billion in the last few months.
So that roll cost gets incorporated into the year-to-date performance, the 4% decline that you're talking about?
Correct. So that you basically already you have an 11% difference just from roll costs in USO. Wow. What's interesting is USO is the one everyone uses, but maybe they should have used UGA, which is the United States Gasoline Fund. This tracks gasoline futures, and it's up 15% this year. And you look at it, the summer driving season is just getting started. People are actually using a lot of gasoline. So it's interesting to see a little bit of divergence between the gasoline futures and the oil futures.
And what's the size of that one versus USO at $2 billion?
Tiny. It's $100 million. A lot of people don't even know this exists. Right. But this one, again, a lot of times in ETFs, if you see one getting all the money, usually if you look around, there's a smaller one doing better.
Let's talk about then also the XLE, which you mentioned, that tracks the energy stocks.
Right. This is the big one, $13 billion. Everyone uses it, tracks Chevron, Exxon. It's up 0% this year. Large caps haven't done as well. But if you look at the one people may have chosen, XOP, it's the oil exploration and production companies. This one has small and mid caps and at equal weights. So it's got a lot of juice in it, and that volatility that you wouldn't want in a down market, but when you're playing a rebound, the small caps will tend to outperform. So XOP is up 4%. And the XLE-XOP relationship right now is right in line where it was in 2009 when oil was up about 70%. That was the last big rebound year. XLE was up about 20%. XOP was up 40%. But again, you're taking on more risk because it has more small caps and it gives them a louder voice.
Well, and at the same time, too, if it's oil and gas exploration and production very specifically, that's tracks even more closely with oil typically than the broader basket of oil services and drillers, et cetera, just quickly.
Yeah, that's right. They're going to be a little jumpier for both those reasons. They're more niche and they're smaller cap. Again, they're higher beta.
Okay.